Asian markets fall following Wall Street's slump as the Fed projects more than 100 basis points of hikes for the rest of the year.
And that's after that hike by an expected 75 basis points overnight. The T-yield spiking, the 2-year approaching 4.1 again.
And the dollar index jumping 1% and blowing past 111 again in Asia trade, weighing on the Japanese yen ahead of that all-important BOJ decision this morning.
At the Singapore Exchange. This is Street Signs.
Okay, taking a quick look at the Fed's decision. The Fed also slashed GDP forecast for this year, expecting barely any growth in 2022 and a little over 1% growth next year. That's calling for just about 0.2% really for 2022. As we mentioned, policymakers expecting the Fed funds to hit 4.4% by year end and a terminal rate of 4.6% sometime in 2023. Mid-2023 is what most people are expecting. Fed Chair Jerome Powell suggesting a front-running of hikes.
There is a possibility, certainly, that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly, today we've just moved, I think, probably into the very lowest level of what might be restrictive, and certainly in my view and in the view of the committee, there's a ways to go.
And even more telling, 12 of those 19 committee members are calling for 4.5% to 5% by the end of 2023 when it does come to that FFR. That is well into restrictive territory. And what we saw when it came to the market territory, selling to the downside to the extreme. We saw that following on from the Fed decision. Then there was a little bit of a relief rally coming through as Fed Chair Powell began to suggest in his commentary that they pretty much kind of sort of might have a handle on it with the policy direction that they are indeed taking. But then the algos took over. And as you can see, this definitive spike to the downside that did play out towards the end of the session. Let's quickly check in on the futures picture in this early Asia session, and its negativity abounds. You've got the DAC off by around about 1%. The Dow's off by, let's call that 0.35, 0.4%. Same goes for the S&P 500. But what has led the markets around by the nose throughout the course of the last 24 hours are the Treasury yields, because we saw some interesting behaviours as well. So following on from that Fed decision, following on from the new target of 4.4% by year end, 4.6% by the middle of the year, the short end of the curve went on an absolute tear. And to be fair, so did the longer duration of the curve at the same time. Then that ameliorated, that came back down. So the duration caught a bid, and you continued to see the upward pressure playing through for the short end. And even still, we're seeing the DXY now at 20-year highs at this 111.62, and that's wreaking havoc when it does come to the emerging markets, and we'll get into that a little bit later on in the show. Just quickly, let's take a look at how some of the stocks performed on the back of all this, because it was tricky to try and find some forms of positivity, but there were some. So as you would expect, the big tech stocks, the ones that you guys are all buying, they were deeply in the red. But Nvidia saw a little bit of a positivity. So did some of the rest of the stocks. Jensen Huang was pretty adamant that if the US and China can start getting along, there could be some amelioration when it does come to the issues that they are facing. They said that they still see a big China market when it does come to the A100s and the new H100 Hopper chips. So they saw a little bit of positivity. Walmart also slicing back a little bit of its expectations when it does come to staffing during the holiday period, 40,000 versus the 150,000 that they hired last time around. This cost control that is in play for Walmart, they saw a little bit of upside. So did the rest of the staples, to be fair, and Lennar. And that is an interesting one, considering the fact that their new orders were down 12%. Their new home purchase prices that people are paying for those new orders was off by $30,000 on what the street's expectations were, but they do have a strong balance sheet. But maybe it's another sign that we are starting to see that weakness playing through. But let's go to our very special guest host on this very important day, Dan Niles. He's the founder and portfolio manager at Satori Fund, and he's joining us from San Francisco. Dan, just firstly, in terms of everything that we saw coming out of the Fed and just that updated track, do you think that this is where it's going to end up being, or do you think that they're going to have to perhaps pause once we see the effects of all of this transmission coming through?
Yeah, I don't think there's going to be a pause. I said that on Tuesday when I previewed this on CNBC. And I think that's the problem, is everybody has been conditioned over the last 13 years that every time the market goes down, the stock market goes down, the Fed then reverses itself. So you may remember in 2018, they were raising rates. Market went down almost 20% in the fourth quarter, and then the Fed started cutting again. And so the big difference this time, which nobody wants to look at because, people want stocks to go up, and that's understandable, is that you have the highest inflation in 40 years. So the Fed can't do what it's done for the past 13 years, which is bail you out every time the stock market goes down, because there's almost twice as many job openings as there are people unemployed. And Jerome Powell referred to that, the Fed chairman's, in his press conference. And I don't think people want to focus on that because the prior record, by the way, Will, is 1.25 times as many jobs as job openings. So you have to really cause a massive slowdown to try to get a control on inflation through the wage component of it, which is obviously tied to the number of job openings versus people unemployed.
So do you think this exercise is futile in that sense because they're not addressing what's happening in the jobs market? And is the rates the tool to do that? Dan?
Well, they are actually impacting the jobs market because they are raising rates and they're slowing things down. The problem is that you have some of the central governments doing stupid things with government policy. So this so-called Inflation Reduction Act, I call it the Inflation Reacceleration Act, because if you're forgiving student loans, all that money is going to go back into the market. And that's why we're here, is that you had so much stimulus early on, which you needed, absolutely, the beginning of COVID, but then you needed to cut that back as you went through and the economy started to recover, and that just didn't happen. So you're throwing more gasoline on the fire in terms of central governments, and so the only thing left is for the central banks to try to raise rates even more to offset that, and that's why you're in the mess you're in right now.
Do you think in the next policy meet, given that we're going to be heading towards midterms, we'll be in and around the midterms at that time, that the Fed would still be able to hike by 75 basis points?
Well, it's a really interesting question, Tanvir, because if you want to be, a conspiracy theorist, Jerome Powell got renominated in November. And then right after the renomination, he threw out the word transitory and then started talking about inflation being more entrenched. Now, here's the thing, though. 45% of people don't own stocks in the United States. And 35% of people don't own homes. But those people vote as well. The other thing is those are the people that least can deal with inflation, because at least you've had asset inflation in terms of homes and stock prices since the pandemic began. But those people are getting killed because they don't own homes or stocks, but they're getting murdered at the gas pump and every time they go to the grocery store or they pay their rent. And so I think, I've got the most respect for this Fed chairman that I've had since he got appointed, because I think he's doing what's politically, disastrous for him, because nobody's going to like him, just like nobody liked Paul Volcker early on. But this is the exact right thing to do for the people that can least afford it. And those people are going to vote in November, just like everybody else.
But isn't the concern as well that because all of these things are lagging indicators in some respect, that they're going to continue to go too hard because the data isn't showing what it should be showing yet because of the time that it takes to transmit that monetary policy? All the while, you're still going to have this QT going at full force as well. So doesn't that risk a pretty serious overshoot and then a pretty serious recession?
Well, remember, 75% of the U.S. economy is services-based. So what's that tied to? Jobs. And remember what I said earlier, you have about 1.9 times as many jobs as you have people unemployed. So the problem you have is not an overshoot. The problem you have is that you might need to raise rates more than what people think, because you've never had to deal with the job market this strong. Over the last 20 years, at least we have that data in terms of jobs available versus people unemployed. So that's what you should be worried about, which is the Fed's going to have to leave rates at a higher level for longer to solve this problem. And people tend to forget, Paul Volcker, he raised rates to 20%, but then when inflation started to come down, he ended up cutting them down to, I think, 9.5. Then inflation took off again, and he had to take them back to 20. So the Fed, they referenced that, Jerome Powell did it in his speech. They don't want to repeat that same mistake. And so I think, for 13 years, we've been spoiled by the Fed.
Sure.
And now, unfortunately, we're going to have to deal with the other side of that, where they got way behind, and now they're going to have to get way more aggressive than anybody imagined.
Right, and they can't be held hostage by the markets this time around because the underlying economic reality is staring them in the face. But very quickly, Dan, I want to get your sense. When you're saying that they're going to be staying higher for longer, how much higher from here? Because for now, of course, the market expects 4.5%. But we had a guest yesterday, from Smead Capital, essentially talking about, Bill Smead, in fact, talking about how the level on the yield could go up to 5.5%. Is that even thinkable right now at this stage? Is that possible?
Oh, absolutely. Because here's the thing, Tanvir, when you look at what the Fed and all central banks used to do, they would raise rates above the level of inflation. And it's called the Taylor rule. And if you look at the Taylor rule, which everybody used before the global financial crisis, that would mean rates should be at 9%. So we're nowhere near 9. And if you listen to the press conference that Jerome Powell had, he talked about the fact that at some point in the future, the Fed's funds rate, he thought, will be about 1% above the rate of inflation. And so if inflation, let's say it's closer to 4.5%, 5%, which is very reasonable to think because you do have so many more jobs and you have people unemployed, then yes, absolutely, you could see the rate go higher because remember, what the Fed's doing today works with the lag, but the thing is, you've got so many jobs you have to get rid of that it's going to take some time to do that when you also have the federal government doing things like forgiving people's loans, which just pushes more money into the market, fighting against what the Fed's trying to do. So, and the final piece, which we haven't talked about, you haven't asked about it, is valuations, because remember, the trailing S&P PE is 19 times. When inflation's above 3%, for the last 70 years, the trailing PE on the S&P is 15 times. That means the market's got to go down 20% from here just to get to average. That's assuming 3%.
Dan, Gill was wanting to comment on that.
Yeah, but does it? Because if you're looking at the 490-odd companies that are running at around about 14 times forward, and you've got the top 10 that are running at 24 times, isn't it really the big stocks that are going to get the beating?
And can they be hit hard?
Here's the thing. Yeah, well, here's the thing, right? Look at FedEx. FedEx looked really cheap up until they reported earnings, missed those by 33%. And then the next quarter, they cut the EPS by 50%. So stock looks twice as expensive today. And that's the part that people are forgetting, I think, is that some of the earnings resets can be just absolutely massive that are coming up, especially when companies are thinking about next year, thinking about their budgets for next year, and now starting to have those discussions with their suppliers, specifically in high tech, to your point, Will. And I think some of the biggest resets you're going to see is in the enterprise space. Because if you think about it from a bigger picture point of view, 3 years ago, every company has to get on the internet. So every company is using enterprise-related software to get their businesses or cloud services to get their businesses onto the internet. And, demand for PCs and smartphone and Peloton bikes and everything explodes higher. Now what's happening is people are switching from spending money on goods to now they're going to restaurants, going on vacation, the movie theater. It's switching back to services. And so that demand for enterprise software and hardware is going to really fall off, especially as you get to next year.
Dan, we have a whole 1 hour with you, so lots more to cover, every angle actually to this story. Stay on with us. We really appreciate you staying back for the next 60 minutes. But we're across the impact of the Fed on all our markets in this part of the world as we also await the BOJ's decision this morning. Kick it off with Sherry Kang on South Korea then. Sherry.
That's right, and let's kick off with the KRW breaching below that 1400 level, the psychological important level. And of course, this is a currency that is highly correlated with the Chinese yuan as well. So we've got the Korean yuan tracking below that 1400 level per dollar across the board. And at the same time, we've got the big moves coming through for Treasury market as well. We've got, especially when it comes to the shorter end of the curve, looking at the most liquid 3-year Treasury yield, for example, in South Korea, that is actually moving by more than 4%. And get this, the yield actually standing now above 4%. And you see that on the board there, the 3-year and 5-year staying above that 4% for a few minutes as of now. And of course, there is that verbal intervention coming from the finance minister, but that's not exactly putting a floor for the KRW at the moment. In the meantime, we've got the Kospi tracking lower by more than than 1%. Now, Emily Tan has the market open in Taiwan and a preview of what's ahead for the Hong Kong markets. Emily, take it away.
Thanks a lot, Sherry. The Taiwan market opening weaker. Let's get the board up because we got a central bank rate decision in Taiwan as well, and very much expected a 12.5 basis point rate hike. TAIEX expected to is traded down about 1.6%. We'll show you the board as and when we can. We're at 14,188, and the Taiwan market bracing for a central bank interest rate hike of 12.5 basis points. The benchmark currently standing at 1.5%. For the Hong Kong market, we have Eddie Yu, CE of HKMA, speaking right now, talking about the FOMC rate decision. Hong Kong Monetary Authority moving in lockstep with the dollar peg. That is what we do here. And the base rate going up 75 basis points to 3.5%. This is a 14-year high effective immediately. The cost of borrowing has increased 5 times in 6 months, but will banks raise their prime rates? They haven't done so yet, currently standing at between 5 and 5.25%. It is their own commercial decision whether or not they do so. Watch out for those banks and the property, those interest rate sensitive stocks. Of course, the Southeast Asian markets, we have Indonesia also out with a rate decision today. Let's get to JP for a look at the Southeast Asian markets today. Good morning.
Good morning, Emily. We also have the Bangko Sentral in the Philippines making their policy decision and what some might say is the reaction to the Federal Reserve's 75 basis point rate hike. That's the question facing a lot of central banks in the Southeast Asian region. Currently, we are seeing that markets, at least the ones that are open now, Singapore, Malaysia, are tracking lower. They're not huge losses so far today, but they are trading in the red. You're seeing the Straits Times Index down by about 0.3% at 3,250 points. The KLCI in Kuala Lumpur trying to hold on to its levels. It's flat to the upside at 1,448 points. We go back into the forex market. So we said the Bank Indonesia Day expected to hike rates by 25 basis points when they open. We'll see how the Indonesian rupiah starts trading at the after 10 o'clock. But the Philippine peso once again back to losing ways and hitting new record lows once again at 58.26 against the US dollar. There are expectations that Bangko Sentral in Manila will hike rates by 50 basis points in the mid-afternoon. They're at their lowest levels in history. The Malaysian ringgit also at their lowest levels and weakest levels, that is, since 1998 at 4 ringgit and 56 cents. We also want to take a look at the REIT space here in Singapore because the property REITs are very sensitive also to interest rate movements, but also reacting to the gradual reopening of the Singaporean economy. We're seeing it's a bit mixed actually so far among the Singaporean REITs, but it is early days. We'll see if there is more of a reaction right now, but markets are scratching their heads. They're trying to figure out how they will respond. And Will, it's really all because Jerome Powell told the markets last night, hey, I told you all that we're not going to stop.
The one place that is stopping, though, over here in Japan, BOJ on that negative rate island, assuming, of course, that the SNB does hike rates as expected. You can see the Nikkei off by around about 1%. The weakness continuing to play through for the yen. You're printing at around about 144.40. Let's quickly check in on the heavyweights to see what kind of trends that we are indeed seeing. Toyota doing all right. They kind of sort of like the weaker yen, so they're printing at around about 40 pips of upside. SoftBank getting absolutely pumped. This is to be expected considering that weakness that we did see playing through for the Nasdaq. What this heightened rate environment does mean for valuations, and especially if they do some of the mark-to-market on their private holdings at the same time. And we're also seeing a little bit of weakness playing through for 7&I. The yen, obviously, we just talked about that. Let's quickly check in on those JGBs ahead of the BOJ decision because it was above that 25 pip band and it maintains that level. So the BOJ has been a little bit more active than they are scheduled when it does come to that bond buying throughout the course of this week. Let's see what they have to say coming up in around about, let's call that an hour and a half's time if we're just doing a little bit of a guesstimate on that. But do not go anywhere. We're going to have more on the BOJ. We're going to have more on the conversation we're just having with our special guest host, Dan Niles, perhaps talking a little bit about those SaaS stocks when Street Signs return. Stay with us.
Niles, founder of Satori Fund, is still with us, our guest host this hour to analyze the Fed's decision and its impact on the markets. Dan, we were having this conversation about market valuations, and Bill was making the point on how the big tech is really supporting the market at these levels. Until, Apple, Microsoft and the like crack big time, the market, it would be hard to imagine the market go much lower from here. Now, we had Bill Smead yesterday talk about how these big tech names could get whacked. Do you have a sense that, with higher rates, you could also see these big names, Apple, Microsoft, and the likes, also lose their momentum? I mean, lose their support and their influence in the markets?
Oh, absolutely. And you got a sense of that actually when these companies reported Q3 results, because if you go back and look at it, all the trillion-dollar companies, Amazon, Microsoft, Apple, Google, Facebook, all of them, the EPS estimates for September came down, even though a couple of those, like Amazon and Apple, actually beat revenues and beat EPS for the June quarters they reported. But in some of those cases, companies played games with their accounting. And, they talked about it openly. Microsoft said we're changing the depreciation life from 4 to 6 years. But what that did was that added 40 cents to EPS for the out year. So if there's another estimate cut coming on the revenue line, because you've got, and by the way, EPS did go down for next year. It just didn't go down an extra 40 cents or 4% because they did the accounting change. If you have a slowdown in PC demand,
but these are still,
you can't cushion it.
I'm sorry to interrupt you. These are still secular growth stories. I mean, you're talking about Apple and Microsoft over a period of time. You look at the period charts there. They almost behave like bonds, in terms of regular dividends, in terms of just having a sustainable ROE. What can break their backs at this juncture? Because remember, Apple also increased prices for its products. So essentially saying that in a tough market, they still have some bit of pricing power. Microsoft is going into the gaming division. And of course, are trying to expand their base, their services line. I wonder where the struggle will be for them to meaningfully get derated.
Well, it's not going to take much, Tanvir, because here's the thing. Everybody's hiding in the big tech stocks because everybody's making this assumption that, it's Apple. How bad could it get? It's Microsoft. Well, if you've seen the PC companies like Dell and HP and others, they've talked about, the spending weakness has gone from consumer to now to enterprise. You saw NVIDIA. NVIDIA pre-announced negatively, and then they cut those numbers. And Intel, after lowering estimates for September by 15% for their revenues, came out, the CEO, 6 weeks later and said, by the way, we're tracking at the low end of that range. And AMD didn't sound any good at conferences either. So with Microsoft, it's pretty easy to see what could go wrong for them.
But do you think the money's going to flow out of them?
The valuation's very high.
But do you think the money's going to flow out of them? Because it would take Insto getting out of some of these big names. It would take retail punters getting out of these names. It would take some kind of a catalyst for that selling to occur because, like you mentioned, everyone hides in them for safety, and it's a pretty easy bet if you're thinking about the next 5 years.
Yeah, but here's the one thing we haven't talked about, Will. What's the risk you're taking on by owning them? And the way you can judge that is what's the valuation relative to the overall market? So if you look at Apple, the multiple is 25 times. If you look at Microsoft, it's 26 times calendar 22. The S&P is trading at 17. Now, a lot of people coming into this year would have said, the telecom stocks are really safe, right? AT&T, Verizon, they pay big dividends, should be safe owning them. It's been anything but. And so the issue you have, Will, is that you have already started the estimate cut process, but as we talked about earlier, the weakness started in consumer. Now it's spreading to enterprise. And it started at the low-end consumer, moved up to the mid-end consumer. Apple's at the high end. So if the high-end consumer doesn't care that their stocks that they own and their home prices are getting clogged,
Dan, we're going to have to leave it there and
finish
this after the break because we're getting punted by the advertising break. Dan Niles is going to stay with us. Street Signs, though, is going to be back in 2 minutes.
China markets coming online this very moment. You'll start seeing the ticks come through for the Shenzhen Composite. The movement will just start to happen. There you go, down about 0.5%, nearly 0.7, nearly actually 0.8%. So closing in for a percent loss for the mainland China markets, and 7.08. We are well past. We're now talking a level closer to 7.10 for the offshore yuan rate. Let's also take a look, zoom in on the China ETF listed in Hong Kong as well to give you a clearer picture. We are looking at the MSCI China ETF down nearly 2%, CSI 300 index down almost 1%, and for the main China A50 futures, or rather FTSE China A50 futures ETF, that is, we are down 1% as well. Hong Kong also joining the trading session. Let's bring in Emily Tan with the opening numbers there. Em.
Thanks a lot, Tanvir. And a relatively sharp fall for the Hong Kong market as we get up and running losses close to 2% as we speak. 362 on the day, 18,079 last traded, 8 shares off almost 2%. The tech index is the underperformer of 2.8%. We do want to take note of the Hong Kong dollar last traded at 7.8497. We are close to the weak side of the trading band, 7.85. If it hits that, the Hong Kong Monetary Authority will have to intervene, as it always does. And speaking of the HKMA, we have moved in lockstep with the Fed. Due to the dollar peg, we have raised by 75 basis points to 3.5% the base rate. The cost of borrowing has increased 5 times in 6 months. We are waiting on those decisions by the banks. Look, let's pull that up. It is their own commercial decision, and it normally comes out when the market is shut. So maybe at lunchtime or after the market close, we'll be focused in on those prime rate. That is, of course, what a lot of the mortgages in Hong Kong are tied to, which currently stands at between 5 and 5.25%. HSBC shares down 2.3% and a 1% loss or more for the rest of the bunch here. Stanchart, Bank of East Asia, and Hang Seng Bank. Worthwhile to also look at some of the property stocks because, of course, interest rate sensitive here, and we're looking the Sun Hung Kai properties down 0.9%. Also a big loser. Shares of Newell Development down 1.5%. Tanvir, that's a look at the Hong Kong market 2 minutes into the trading day.
And we'll come back to you for more through the course of the show. Thanks very much for giving us the initial highlights. Dan Niles is still with us, founder Satori Fund, as our guest host all this hour. Dan, I want to talk about this part of the world and the reaction to the Fed coming in. I know you've traded in Chinese tech stocks in the past, with all the regulatory issues around that sector. But the rate differential story is key right now in terms of how the Chinese authorities, the PBOC, is stepping down and stimulating the economy to prop up growth. How do you view and look at that gap between what the U.S. is doing versus what China is doing in this part?
Sure. I mean, it's a really great question, Tanvir, because the Chinese government is trying to stimulate their economy on the one hand by monetary policy. The problem is that they're continuing to shut down cities when COVID springs up. And we're going into the winter. And don't forget, COVID is a coronavirus. It is a close relative of the common cold. And there's a reason we get our flu shots every winter, because you're going to get more cold flu season kicks in. So for me, I look at it and I go, they're almost doing the exact opposite of what the U.S. is, in the sense that their central bank is cutting, which in the U.S. they're raising. But what you're doing is you're having the government authorities locking down cities, which is then slowing growth, where in the U.S. you're forgiving, student debt to stimulate inflation. So I'm staying out of the space
growth,
right now.
Dan, if somebody's chasing growth, should they get into China? Because the regulatory risks have somewhat played out.
Yeah, I think it's a don't touch either way. I'm not short it. I'm not long it, because again, they're cutting. I'm more inclined, if you put a gun to my head and said, you got to pick one, I'd be more inclined to try to be maybe long it. But I think it's a dangerous situation because, again, you're going to have, I think, a lot of cities getting locked down when we get into the winter and COVID springs up again. It's just going to happen just like with the cold. So that's why I think it's hard to do it. I think as you get into next year, the weather gets warmer and then they can start to unlock cities. You've got that big interest rate differential, which is going to be even wider, right? Because in November and December, Fed will be raising again. Then I think it might get a lot easier to look at that space. For right now, I'm not touching it. For that reason. And the regulatory stuff, obviously the U.S. is going to go in and start auditing companies very soon in China. But are there going to be some issues there if there are some companies that, they consider very sensitive, which we know they do, where they don't let them in? And so then we have to go through one of the big tech stocks where they consider they have sensitive information on their citizens, where they won't let the U.S. government in. And so then you have another round of stocks going down because of that. So that's something I'm looking for in the near term, too.
And the other big thing we didn't mention is property. Dan Niles, stay right there, because we're going to be talking property when it comes to the United States as well. Lennar KB Home reported their numbers after hours. You did see Lennar popping a little bit on the back of that, despite the fact that their Q3 new home sales were down around about 12% on year. Even despite the fact that they did see lower prices, their balance sheet remained requisitely strong. But we also had Fed Chair Powell having something to say about the high levels of housing prices. Listen in.
The deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And, that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place.
But how steep or deep will that correction be? Joining us now is Stephen Kim. He's the head of housing research at Evercore ISI, joining us from Raleigh, North Carolina. Dan Niles, of course, obviously still with us. Stephen, you don't necessarily think that housing prices will go down all that much, do you? Or the new home prices?
No, I think a lot comes down to what does Powell mean by a correction, because that can be interpreted in many different ways. So obviously we are already seeing a correction, nearly 20% or so in terms of housing starts. So if he's talking construction, that certainly is already underway. I would say same thing for existing home sales, that's already underway. If you're talking about prices, I would tell you he probably does not mean a 20% reduction in home prices, and yet that is what is priced into the home building stocks, which obviously is my main area of focus. And that's why we've been saying that these stocks are pricing in too much negativity. And so, as you said, Lennar put up results even in the midst of this huge move in mortgage rates, and yet the results were met with, frankly, a little bit of a yawn or even a little bit of a positive reaction because of how incredibly inexpensive these stocks already are.
Right. Very quickly, Stephen, where are the opportunities then? Because it's not all down and out for the housing market in the U.S.
Yeah, I think that one of the things that's very important to understand about the U.S. is that there is this fear that home prices are going to drop, as I said before, 20 to 25%, because they have risen 30% in the last couple of years. And so there's this idea what goes up must come down. That's not really actually the case. In the United States, the only time we saw home prices down more than a couple of percent was in the great financial crisis. When that happened, prices dropped 30%, and people are saying, well, gee whiz, couldn't that happen this time too? The answer is no. There are many very important differences between the market today and the housing market back then. Just to take one of them, if you look at the level of inventory on the market, you will see that inventory levels were at record lows for the resale market and the new market combined before the pandemic, and then they dropped another 30%. We are at levels of inventory that we have never seen before. They're frankly existing home sales at 3.2%. Historically, we didn't see prices go down until you got 3.2 months supply. You didn't see home prices go down until you reached 8 months supply. So that's one example. Another example is the mortgage rate situation. People are worried that rates are very high right now, 6.3%. They were below 3% not that long ago. But remember, in the US, people have 30-year fixed mortgages, and they also can refinance those mortgages. Most people
Stephen,
have refinanced.
Stephen, one question for you, though. That month supply, though, that you're quoting, that's a ratio. And so that relates to, you've got 4.8 million existing home sales today. If you look back to June of 2010, which was well after Lehman had failed, well after the bottom was reached in the stock market, it was June of 2010 that number got down to about 3.5 million. So the inventory of months of home on the market could actually be a lot higher. The second question I guess I had for you is, that your home builder space trades at 1.8 times book value, but how much did book value go down during the global financial crisis? So couldn't that also be overstated?
Yeah, so these are all great questions. Let's look at it this way, Dan. The level of inventory on the market as in months supply, as I said, is about 3 months. Historically, you didn't trigger home price declines until you got to about 8 months of supply. Another way you can look at it is that right now that inventory levels in total units is about 1 million units shy of normal. So we have a very low level of inventory on the market. Now, you said that home sales obviously went down a great deal in the GFC. Remember, the GFC was a situation where you had tremendous amounts of people who could not afford their homes that they had already bought, and they were kicked out. They were removed. Foreclosures were rampant, and that really poisoned the market, and that is why we have that's why we call it the Great Financial Crisis, because that's truly what it was. And as I said, if you look at the market today, the average person who has a home and a mortgage has a rate below 3.5%. If you can fog a mirror, you can afford your mortgage payment, and those payments are fixed for 30 years.
Yeah.
In the lead up to the GFC, the majority of people who bought houses did not have a did not have a fixed mortgage rate with a payment that they could afford when things got bad. And so you had a wave of foreclosures. That does not exist today. And then also, I would say, if you look at the valuations, and you were talking about price to books, most of the small cap home builders are actually trading below 0.8 of book. People are expecting those book values to go down. The only way that happens is if you get losses. Losses in this group only happen really when you have impairments to your land assets. That is not going to happen today unless home prices drop 25%, which is what I started with. That's what's priced in.
We're almost out of time, but just for the investors watching, why should I buy Meritage? Why should I buy PHM?
Because home prices are not going to go down 20 to 25%. The bottom line is if you don't have forced selling, you're not going to have home prices go down that much, and therefore these stocks are dramatically underpriced.
Stephen, lovely to have you on the show. Thanks very much for stopping by with your thoughts on the U.S. housing market.
Thanks.
Okay, time now for a short break, but coming up, we continue our coverage on the Fed's decision with Tom Porcelli of RBC Capital Markets. We'll be right back with that and more. Tom Porcelli is the chief U.S. economist at RBC Capital Markets, joining us live from Bedford, New York. And Dan Niles from Satori Fund continues to be our guest host this hour. Good to have you, Tom. Thank you very much for your time. Weigh in on this debate of valuations and how long will the market hold up before it really cracks to the reality of the underlying economic situation worsening on account of the Fed's battle against inflation.
Yeah, look, our stance has been for a while now that the real risk here was that the Fed was going to overdo it, and that they would usher in, sort of a more severe slowing in economic activity than I think we actually needed to have. And unfortunately, it looks like this is quickly now becoming reality. So, we have another 75 basis points waiting for us at the next meeting, and then 50 after that. So we get to 450 on funds. I mean, when I think about the economic ramifications from that, I can tell you should not be looking in the Fed's summary of economic projections for what that kind of Fed funds regime is going to give us, because 4.4% on the unemployment rate next year, and then holding there the year after, that's not going to happen. I mean, that's a fade. You're going to see an unemployment rate that probably rises meaningfully more than that.
Right. I just want to mark the flash on our screens because it's very important. The 210, Dan, and I'll come to you with this one, has widened to nearly 56.5, because you rounded off to 57 basis points. Most significant as the gap widens, and obviously people build more bets for the shorter end of the duration, shorter end of the yield curve. What's your view on how deep a recession and how significant a recession are we staring at because of these rate hikes?
I think we're staring at a very deep recession because, remember, we're here because of 13 years of the Fed expanding their balance sheet and central governments around the globe adding stimulus to deal with first the global financial crisis and then COVID. And that's why valuations got to the highest levels we've seen since the tech bubble. So it's going to take, if you took 13 years to build this bubble, it's either going to be short and incredibly painful, or it's going to be long and protracted, because you're going to have to go through that pain of taking out all that stimulus you put in to get inflation down. And so that's why, from my perspective, our target on the S&P is down 30 to 50%. We've been saying that since May. Our single point target is 3,000 on the S&P. And that's based off of 200 in EPS for 2023 and a 15 multiple on that 2023 estimate of 200 to get us there. I'd be actually curious as to what Tom is thinking, if he has a range that he's thinking for the ultimate bottom and what the earnings and multiples are that he's using for that.
Tom?
Yeah, Dan, I don't do that. We leave that to our equity strategy team. I'm just an economist, and I try not to tread on my colleagues' toes. So I would leave it to them. But Dan, what I would say is, I think a lot of what you said we would agree with. The backdrop, I think, is so. Here's my problem with the backdrop. The recession idea, I think, hopefully we all appreciate at this point that, hopefully we've moved beyond that conversation, because I think now, to me, it's, what does it really look like in terms of duration, and what does the recovery from this look like? And I think there's where I think, this could feel really ugly, right? So just to sort of lay it out a little bit from our perspective. So and I'm being generous here, but at a minimum, for the next 6 quarters, so basically Q3, which obviously we do not have data for yet, straight out to the end of the end of next year. So the next 6 consecutive quarters, we will have growth on our estimate that will be below 1% every single quarter. I want to be clear on what I mean by that. I'm not talking about it averaging less than 1%. I'm talking about every single quarter for the next 6 quarters will be less than 1%. We have never seen anything like that. That would be wholly unique in the United States. And why is that important? Because I think what that really drives home is, everyone's sort of looking for like this, the recession beginning and end point, right? I mean, I think that's where a lot of the conversation sits. But what I would submit to you is, this is going to feel probably like a pretty long recession, right? I'm not so worried about the depth of it right now, and make no mistake. I think, again, the Fed could really drive us down even longer. I'm simply saying that it'll feel recessionary for perhaps the next year and a half. That is an ugly dynamic. It's sort of akin to the GFC. I'm sure all of you remember the GFC, the post-GFC window, when it just felt sluggish and like we were still in a recession. I think that's that feeling that you're going to have here, and that's probably the next year and a half.
And we also don't know the impact of, I was just going to say, we also don't know the impact of QT. You also don't know, moving forward, the perspective that there could be even more downside risks to come in terms of the global macroeconomic conditions. But the question I have to ask you, it goes back to employment, because you're suggesting that it's nonsense in terms of the 4.4 they're expecting. So what do you think is going to be the outcomes in terms of the labour market over the course of the next year?
Yeah, so right now we're looking at, by the end of next year, you're easily holding a 5 handle. On funds, on the unemployment rate. Again, Fed 4.4, just as way of comparison. If that comes to fruition, you could easily be looking at, at a minimum 2 million jobs being lost. Now, again, I think sometimes the conversation gets a little muddled in that if you think about the last 2 recessions, they were dramatic to say the least, right? We had a pandemic recession and then we had the GFC. If you look back at prior recessions, so call it, the 01 recession, the 90 recession, we lost roughly 2.5 to 3 million jobs. So it probably feels something along those lines. But again, and this is where Dan could really provide some great color for us. Tell me what's going to happen from an earnings perspective, though, because if earnings are going to get walloped, that is going to sort of remove the floor underneath what could be a sort of a relatively modest number of job losses. But if you're going to see earnings get dinged up, job losses will be meaningfully more.
Yeah.
Well, I think, tied to your point, Tom, is that fact that if you look at prior recessions, you've had a 20% reduction in S&P 500 EPS from wherever it started. So you had 2 years of S&P 500 EPS going up. The first phase of this drop in the stock market is all multiple related. The next phase, I think, is going to be earnings related, in that $250 EPS estimates for next year for the S&P goes, like it should in an average recession, down to about 200. And that causes the issue. And to your point, in terms of length, the global financial crisis took 17 months for stocks to finally find bottom from their peak. For the tech bubble, it was 31 months. If you look at even during the 1970s to 80s, those 3 inflation-led drops, they averaged from 18 to 21 months. This peak in the stock market only happened in January. So that would get you to middle of next year to end of next year before you find the ultimate bottom, which is, by the way, where we're thinking the market does bottom, is in the back half of next year to mid next year.
Yeah, and that's what the CNBC Fed survey is also indicating, that rates will stay higher and the markets will also react to that for about 11 months through the course of the next year. I just want to wrap things up, Tom, with your perspective on the dollar, because 111 is eye-popping.
Yeah, look, here's the challenge. The U.S. is, as I hopefully have made clear, is going to have a lot of challenges. Unfortunately, those challenges might pale in comparison to what some of our sort of big trade partners, not the least of which is the euro, might go through. I mean, it's entirely plausible that Europe is, basically on the border or on the verge of recession right now, and that it could be meaningfully worse in Europe versus the United States. So, that on the face of it would sort of lend some support to the dollar at a minimum remaining strong. But again, a lot of that's going to be dependent on how a lot of these other countries are going to manage this process. And look, I think that there's a really interesting way of thinking about that, just as, again, just sort of a snapshot. A snapshot of the globe right now looks like this. If you look at, we have a global PMI heat map, manufacturing PMI heat map. 3 months ago, 75% of these PMIs were expanding. Today, only 20% of them are expanding. The globe is slowing rapidly.
Tom, we're going to have to leave it there. Thank you so much for joining us on Fed Day. Hopefully we get you back on soon. It's Tom Ficelli from RBC Capital Markets. Now for some final thoughts with Dan. Dan, we've gone this whole hour, and I bet you there's a lot of people watching the live streams that are going to be asking themselves, what is Dan buying right now? So share, spill.
This is the thing you have to remember. We're up for the month. We made money today. We're up for the year. But it's not because of our longs. It's because of our shorts. So for us, and if you go to @DanielT.Niles, my Twitter handle, or danniles.com, we lay out the case for this. But you're going to get these bear market rallies. When the S&P gets down to that 3,600 level, which is where it hit bottom in June, it wouldn't surprise me to see another one. And we predicted some of the ones in the past. But I think where we're looking at to make money is on the short side. It's to go after the big enterprise names, the big internet advertising names. Don't forget Disney, Netflix coming out with, their streaming services. So they're going to suck in a lot of ads that other people would have had. And, PC, smartphone stuff. The stuff, if you're forced to buy something, Walmart, we own that. It was up 18% 08 when the market was down 38%. That's the kind of stuff, defensive healthcare.
Okay, so you're shorting a lot, but for the average viewer out there, for the average retail investor, they want to know about safety in this market. Where do you find safety in this market? Where are you?
Also, they would just get inverse leverage ETFs. Is that the play?
Capital protection ideas, Dan.
This is, and I've said this on your show several times, Tanvir. For the average investor that can't trade this daily, stay in cash. There is nothing that is safe. I mean, I own Walmart. I hope it goes up even if the market gets crushed, but we have tons of shorts against this. So unless you're comfortable shorting or getting out, and then buying back in near bear market bottoms, which we've been trying to do, in this kind of downturn where the Fed, into a growth slowdown, is raising rates, trying to make the housing market, in their own words, go into a correction and trying to drive unemployment up. The only other time this has happened is in the 1980s, and that did not end very well. So down 20% in the S&P is nothing.
Can there be safety in cash right now? How much cash should one have in the portfolio? Very quickly, because we need to wrap up.
Yeah, so we have over 20% of cash in the portfolio, and we have more shorts than longs, and that's how we're making money.
Thanks very much, Dan Niles, for joining us, founder and fund manager, Satori Fund. We'll be right back after the short break with our coverage